You've been hearing a lot about the market crashing, but what about the real estate market? Is that crashing too? Today, we're going to talk about just that. Stay tuned. Hey everyone, Brittany with Brittany Hannon Real Estate, and today we're talking about a market update for March of 2021. Can you believe it's been a year since COVID hit us in the US? There's a lot that's happened over this year, and today we're going to talk about what is happening moving forward. If you haven't already done so, hit that like and subscribe button. Hit that notification bell so you get videos just like this as soon as they come out. Now let's jump right in. Now we've talked about interest rates declining over the last year. We saw interest rates go as low as 2%. Sometimes I heard people getting as low as 1.8%. That is crazy low. We've already talked about how those low rates have made it so there are tons of buyers, and those buyers are going to buy houses that aren't there. There's such a low inventory. People are not willing to sell, whether it's because they've refinanced their homes into that lower rate, or it's because they're worried about this pandemic and don't want people to let them into their homes, or they're worried that they're not going to be able to find a home because they're shopping in the same market as they're selling. For whatever the reason, we know that the inventory is so low. On average, we have about 5 to 6 months worth of inventory in California. Now, what that means is that if no houses came on the market, all of the houses would be purchased within 5 months. Well, right now, what we're seeing is we have less than 2 months inventory on the market, which means that if we had no other houses come to the market, we would be out of homes within 2 months. Now that is crazy low inventory. So we've talked about how that low inventory drives up the prices because we have so many buyers and the competition is so fierce that they're willing to pay almost anything to get into this house. They're willing to go 30, 40, 50, sometimes $100,000 over asking price, remove all their contingencies. People are doing drastic things to be able to get into a house. And we can see why. This pandemic has made it so that so many people are remote workers. They're working from home and they need an office space. They need more space for their kids to run around and play. They need to take advantage of these low interest rates so they can lock them in for the next 30 years. So many reasons to be able to buy right now, and they're all great reasons, which is why there's so much demand and those prices just keep going up. Now, what we're seeing in March is that interest rates are starting to creep up a little bit. The economy is stabilizing out, which means that the Fed is trying to increase rates just a little bit because they know that the economy can handle it. So rates are going from about 2.5% to 2.8%. Now they're moving up to about 3%. And they're projecting that the interest rates will stay in the low 3s for the foreseeable future. So we don't have to worry about that too much. However, going from 2.8% to 3% is actually a big jump. When we run the numbers, we're going to see that that is a big increase from what you can afford. So you can see with a $700,000 loan at 2.5%, which we've been seeing a lot of over 30 years, your monthly payment is $2,700, $2,765. But if we change that to 3%, that monthly payment changes to $2,900 a month. That's a pretty big increase, especially if you're looking at the monthly affordability for your family. Now, we talked about home prices going up, and what we're seeing is that home prices will continue to increase. In February, chief economist of Freddie Mac, one of the main mortgage lenders, put out this statement. Reaching its highest point since mid-November, the 30-year fixed-rate mortgage averaged 2.81% this week. Economic spending has improved due to the most recent stimulus, but supply chain shortages are causing downstream inflation, leading to higher mortgage rates. While there are multiple temporary factors driving up rates, the underlying economic fundamentals point to rates remaining in the low 3% range for the year. Now, what that means is that even though we're seeing some temporary changes to interest rates, overall, the underlying factors make it so that we are going to see that low 3% through the end of the year. So many people think that we're in a bubble and that it's going to have to pop soon. Now, what that means is that home prices have been increasing and increasing and increasing, and people are thinking that at some point this has to stop. But the reality of it is that because there is so much demand, that is not an artificial inflation. That is actual home prices being driven up. And what we're seeing is that home prices are still projected to increase by 3 to 4% this year. So while it seems like there's a bubble, we're just not quite there yet. And remember what I always say is that if you're looking to buy for a long period of time, maybe 5 to 10 years, you really don't have to worry about that. Because if you look back over history, even in our deepest recessions, they have recovered over that time. And so we're seeing prices now that are above what the highest prices were in the 2005, 6, 7 bubble. And then of course, everything crashed and prices were astronomically low, but now we're above what those prices were back then. We're seeing that this is due to inflation. This is due to less housing available. We're seeing that this is due to a lot of things that are really generally not going to change that much in the near future. Now, because of all the buyers in the market, home sales have also continued to go up, and we're expecting that to continue to grow to about 7% this year, which means there are 7% more home sales this year than there were last year. That's pretty significant considering we only have 2 months worth of inventory on the market. The last thing that we'll talk about, which I know people are concerned about, are foreclosures. In the last big recession, foreclosures were everywhere. And the reason for that was because so many people were getting mortgages for 80% of their home, and then they were getting a second mortgage for the remaining 20%. So 100% of their home was financed. And usually a good majority of that loan was an adjustable rate mortgage, which means that as rates go up or go down, those prices are going to go up and go down. And they usually had a balloon payment. So a balloon payment means you had to pay the whole thing in full in 3 to 5 years, when so many people were not able to pay it in full. So when those banks were calling those loans due, people were saying, I can't afford that. And they were just giving their house back. Well, when that was happening at such a huge scale, all of these foreclosures happening at once were driving all the prices down on all the homes, making it so that the banks couldn't get their money back out of them. And that's why the banks were failing. So there were a lot of different factors going into the Great Recession in 2008. We are not seeing those same things. Basically, everybody has a 30-year fixed rate mortgage, meaning the rate you get today is not going to change for 30 years unless you refinance or sell. When people are locked into that, there's way less of a likelihood of foreclosure. Also, a majority of homes have more than 40% equity in them, which means that even if they had to sell, they could sell instead of going into foreclosure. Now, what we're seeing is that a lot of people did take advantage of the forbearance, but we see that 91% of homes in forbearance have at least 11% equity in them, meaning that if they were forced to sell, they would be able to walk away with cash in their pocket. This is not the same scenario as we were seeing in 2008. In 2008, people had financed 100% of their mortgages, and then when they were trying to sell, they were completely underwater. They owed more than what they could sell their house for, and so they were having to just walk away from it and have a foreclosure on their record because there was nothing else to do. This is totally different. I hope you see that because that's all I've been saying. We are not in the same situation as 2005, 6, 7, 8. This is a very different type of recession. The chief economist at NAR, the National Association of Realtors, says any foreclosure increases will likely be quickly absorbed by the market. It will not lead to any price declines. So people are a little bit concerned about that prices are declining. So maybe we should wait until that happens and then we can buy low. But the reality is that things are just continuing to go up, including interest rates, including home values, including people coming onto the market to buy. So your best bet is to buy now. So that's it for today's video. Thank you so much for watching. I hope it helped. Leave a comment down below to let me know what you thought was interesting in this video and what you want to hear about next. I want to make content that is relevant to you. Be sure to like and subscribe, and I'll see you in the next video.